Hello accounts people, time to have a look at one of the practice papers for Business Tax FA2024. I'm using one of the publishers. I have stated this before, I don't like using the AAT ones. They are perfectly good and very valid exercises. They are very, very important exercises. But I'm always worried that somebody will watch the video before having a go at them. You should always have a look at one of the videos that somebody's done on an AAT practice paper. After you've had a go at the video, you will learn far more from what they say and what you've done. But there's loads of publishers, 4 regular publishers, 3 more famous than the other one. Other people produce practice papers, so we can play around with one of the publishers. This is Osborne. It's a really good publisher. It's a really good practice paper, so why not use it instead of degrading the sacrosanct AAT ones, when you can use the AAT one more effectively by not watching anybody do it on video first. So anyway, I'm just going to do the first few tasks and we'll see how we get going. I've already uploaded, actually, as I'm recording this, the last few tasks, so I know I'm not going to do the whole lot. So first task. So this paper generally, according to the examiner's reports, by and large it's a reasonable pass rate. It's much better than most of the other level 4 exams. It does have some written ones in. I'll put those in a separate video. Still working on the script for those. And by and large the tasks are fairly even. A little dip on one of the written tasks. But this starts off with some nice tick boxes, and we have of course got the very important reference material. Looking at the reference material should solve all your problems, because most of the first bit, if they're not common sense, will be in the reference material. If it's not, it's because you really are expected to know it without looking anything up in the reference material. So let's have a go at these reference material. Now, discounts allowed is a normal everyday discount that you give your customers. So there is absolutely no way it's going to be anything allowable, perfectly no action. We don't need to do anything with it. It's perfectly okay sitting in accounting profit and tax adjusted accounting profit. However, this one, the second one, isn't. Now, if you go back to FAPS, you were taught general provision and specific provision for bad debts. General provision is not allowable. Now, this is a reduction, so it would increase, so we're going to take it off. The other way around, if there's an increase in general provision, we disallow. The specific one, however, is acceptable for accounting because you know the customer in concern, you've nailed it, you've said this is the one that's going to go bad on us. Gives the phone cases with the logo costing £12 each. Maybe time quickly to flip to the reference material. Just have a look what we've got. Just check the numbers in it. Okay, this one's fairly easy. Entertaining and gifts. Customer gifts unless less than £50. That's okay. There's no alcohol mentioned in this. And contains business, it's an and, not all contains business advertising. That is fine. Nothing wrong with that one. So allow no action means we're okay. So non-trade interest receivable. Okay, define what that means. It's from a bank account or something like that. And we're talking about the taxable trading profits. So we take that out. Doesn't mean to say it won't be taxed, it just means it's going to be taxed elsewhere. Legal fees for purchase of new office building. Well, we put those in as an expense, but they're not, they're capital. So again, we're not ignoring them, we're still paying them. This is going to be added to the capital cost of the new office building. And then business rates is perfectly okay. Just why on earth that's in there, I don't know. Hopefully it won't catch many students out if it comes up. Normal household rates, that of course wouldn't be. And then the last few true falses. Let's have a look. Let's read carefully because they can be a little bit tricky. especially on task 1. Obviously by the time we get to a few later tasks you might be reading the wording a little bit better, might be able to come back and reread and realise you didn't quite read it properly. If you get this wrong, or any of these questions, it's probably because you misread them more than you didn't know. So dividend income is part of taxable trading income for sole traders only, but not for limited companies. It's nothing to do whether it's limited companies or not. The only time dividend income will be part of taxable trading income is if you're an investment company. Salaries of directors are allowable costs for limited companies. Owners' salaries, well, definitely not. There's no such thing as an owner's salary. It doesn't exist. Drawings. And of course you add it back on, so it's not an allowable cost. One of my annoying things where teachers at level 2 are taught drawings as an expense. They're not an expense. They're the owner taking out their capital, and of course they have to be added back on when you calculate the tax. Unincorporated business, again, sole traders, partnerships, cash basis is default. That's true. Can opt to use, yeah, that's fine. That's part of the rules, which hopefully you know by now if you're looking at practice papers. There we go. Onwards, task 2. Numbers, not tick boxes. Calculations. Generally suits small companies. So this is a sole traders capital allowance question. Just bear in mind that you may get a company, in which case is an extra column usually, or sometimes 2 extra columns, various versions of layouts. 12-month period, that doesn't solve the problem. And of course you've got to know for a sole trader, 60% business use, you can only claim 60% of the capital allowance. So let's do the numbers. Now I must admit I'm not over impressed with the publisher's answers here, but we don't know what it looks like, so in reality they're manually marked. If you get the numbers right at the bottom, no examiner is going to look too far. But what we need is to lay it out accordingly. AAA, that's okay, don't have to worry about proportioning it or anything like that. General pool, car, doesn't need to really say that it's a 60% business. You would have to have a separate column for every car. And then the actual capital allowances. I'll put a pound sign in that one. So these are all pound signs, of course. So we'll put the pound signs in just to remind us that's the pound signs. Breakdown brought forward, usually something along those lines. These amounts are straight off there. So the general pool was 45,000, the car was 16,000. Normal to do. This one first. I haven't quite left myself enough space to get it in. There we are. Sorted. There's only one here, so we could possibly do it on the on one row if we needed to. So the cost of the machinery was 828,750. And we're taking off the whole amount. And therefore claiming it. Of course there is a limit to AIA, and of course it is reduced for a short time period, so on a different day you might not take the whole amount. You may for some reason not choose to take the whole amount off. I mean, if this actually, it is arguable But if this turns into a loss, you may just save some of that, put it into the general pool or something like that. Right, so there's no more acquisition, so the next bit will be less and disposals, because the capital allowance is calculated after the disposal. If you don't do this, if you put the disposals after you've calculated capital allowances, yeah, you could potentially come to the same right number, you remember, but it'll look a bit of a mess. So this is something out of the general pool. So our computer to the brackets. That means we now have subtotal effectively. Doesn't really need a heading, that one. Now we've got the serious workings out, we have got the WDA. So again, if you've got separate and enough rows, we can split this up a little bit. I'll have a look, see how many I've got in a minute. WDA, so that's nice and easy. So 6480, that needs to be, does really need to be a minus figure, so just to show 6480. I'm looking at the number of rows and the number of columns. I would like to show that this we do the normal rate, and I'd like to see the fact that we're then doing 20%. Have I got enough rows? Probably. So $2,880. Again, I'll do the naught minus. And then I need to show that when it goes in here, so I'll put it here 60. That when I pop it across to here, I'm only doing 60% of it. The 7228. The full amount will still come off the value in the property, so that's why I left the 2880, just making life easy for myself. Carried forward, we're now down to 20,520. General pool. No, we're not. That's 29,520. 9,000 in. And in the car is now down to 13,120 in the books, and the all important figure, of course, down the bottom. Now bear in mind, these records are permanent records in a business as long as it exists, so they're one of the records that doesn't belong anywhere. Forget the retention rules, which may at some point be tested in the exam. Forget the 5 years plus for sole trades and 6 years for a limited company. Of course, bank records are kept for 10 years anyhow. These are permanent records as long as you've got a balance on your pools and as long as the company exists, just like the SBA calculations we're about to do. Right, so SBA, so reasonably awkward SBA question. Let's just have a look, just really carefully. So Green Limited, a warehouse, and Red Limited, 1,150,000. Land, of course, isn't part of SBA, so we know that's only going to be 1.1 million anyway. However, Red Limited, the people they bought it from, first owner, and they'd already been claiming the structures and buildings allowance at a rate of £21,000 per year from 2021 until the sale. So the rule is, once it starts to be claimed, you've got to carry on claiming at that rate for the remainder of the 33 and a third years. So we need to explain this and then do and calculate. So explain calculating. Not essential for the answer. We don't actually know when it was 21, so they've had about 3 or 4 years. So they won't be able to claim forever, or the normal 33 and a third. There's no harm in doing that one. Claiming 21,000. So as with all written answers, anything relevant. Again, is it essential to put this one in? So the qualifying cost would be £700,000. Emphasise it, why not? And of course not the land. So let's do right, so let's just do the calculations then. So note this is not a full year. Again, reading the questions, year ended 30th of June and they bought it in December. So December, January, February, March, April, May, June. So it's just about knowing the rules and showing the examiner, whoever's marking it, that you know the rules. That you know it's only the original cost, Not bad, so that you know that it's the remainder of the 33 and the third years, and that once it's been claimed by somebody, you have to carry on claiming at the same rate, not the 1.1 million. Also knowing, I was showing the fact that you know the land isn't included as well, and also noting in the scenario, examiner does mention students missing things like information in the scenario. This is only 7 months. Done. Right, that's 3. Onwards. Roger and Sylvia. So partnerships. This is partnerships and NI. This task. Shared profit equally for some time. Don't really need to know too much about that. 1st of January they've changed. Presumably, Roger's put some extra money in or something like that, and therefore said I want a bit more out of it. But why not? Roger and Sylvia, very quite old names. You'd expect people like that to be running a bookshop or something. Maybe they're just getting into retirement. Anyway, so taxable profit of the partnership, 31st of March 2025. That's by 124,600. So again, we've got to play again with our months. Maybe bring out our lines. So we're looking at. Well, it's a whole year anyway, so it's a whole financial year, so we ain't got to worry about calendar years. December 24, and then from 1st of January. So yes, on your fingers, or if you're really struggling, on a number line. I have done a number line that I've used on a few questions. So January, so the first in the tax year was March. So that's the 12 months. In fact, I've actually gone into there. Maybe I'll just do this thing. Add a few more months to it. It could be a good investment in time and accuracy. Noting this one now, going back to the question, 31st of March, it changed on the 31st of December, so we're interested in that bit. 9 months and 3 months, so not sure what I've done there. I should put copy it right. So the rest of it, so it's 9 and 3 the split. It is mentioned several times in the examiner's report, students miscalculating the number of months in a question like this. So the share of the profits, 50%, so what are we going to do? Well, first of all, we've got to work out the profits for the 9 months. So it's just 124,600 divided by 12 times 9. It's going to be awkward. It's not going to work. Oh, big maths. That's the share of the profits. However, we've now got to divide by 2. So 46,725 each from the first 9 months. Now after that we've got interest on capital. Remember it's 3 months. We just work that one out, don't forget it. Don't apply it to the first bit and the second bit, but forget about the third bit. It's for all these calculations. So interest on capital, he will get is we'll do it as a formula, E6 times 4%, what's 3 months, so divide by 4 will work. £960. And Sylvia will get times the 48,000 and divide by 4. Half, of course, because she's only got 48,000 instead of 96,000, so might better do that one a quicker way. The salary, just watch out, it's a salary per year. So quarter of 10,000, not waste time doing the calculations, and a quarter 16,000. And now we've got to work out the share of the profits. So what we've actually got to do is work out the profit figure first for the second part of the year. So actually it need working out a little bit separately, no harm in that. Separate bit of paper, don't try and work it out straight into these numbers, but we're going to add those back up to the number we're going to work out here. So we had 124 600. That's the profits for the last 3 months, the quarter of the year, and then we're going to take off the 960, take off the 480. These are both deductions. If it was interest on drawings, we would be adding it back on. It's just revision of level 3 stuff. So 940, so we're just going to take that amount off, give us profits of 23210, and he gets 60%, and she gets 40%. And of course we can double check on the spreadsheet back to our 23,210. Pretty predictable question. So her national insurance then, 424.25. So if a student was going to make a mistake on this, it's probably forgetting her original profits. So we need to just remind ourselves that we're doing her 46725 and her 9284 share the profits and her £4,000 and the interest on capital, because it's 4%. And then we can start working out her national insurance. So we might as well do the sort of the meaningful work here. So 82389 minus 12,570 is 505.89. No, we haven't got that wrong. What am I doing? Plus 46725. Oops. Right. That looks better. So what we know is that 0 to 12,570 is 0%. That's in the reference material. We've got 37,700 at 6%. Put that one in. If you haven't done the personal tax unit, the 37,700 is the bandwidth at which you pay 6%. I'll go on to the reference material in a minute and show you. It's after pence, so yes, that's right, 2262. And then the rest, more than one way of doing this. The last is at 2%. So if you've done the personal tax unit, you will have no trouble with this one. And where have we got the 37,700 figure from? Let's go on the reference material. I did that actually without going to the reference material. Easy when you know it off by heart. National insurance. So class 4 contributions between 12,570 and 50270 50270 minus 12570 is 37,700. So that number comes up quite often in tax calculations. It's the bandwidth. It's also the bandwidth for 20% the basic rate of tax, and then the rest of it is the 2%. Nothing on dividends, and obviously salaries are the same. Right, that's one that we'll put on this video. Building sales, and we've got index numbers in here, so a lot of students don't like the index numbers. So, and we've got to look some numbers up as some information up in the reference material for the bottom bit, or check if we didn't know the rules. It's easy for me, I'm teaching it, I know the rules. So, Telford's, they're a limited company, not a sole trader. They sold a building for 580,000. They bought for 400,000, but they immediately spent £60,000 on acquisition. The £1,500 guttering is just a revenue expense, so that's nothing to do with that. It's just to try and catch you out or tempt you. But we can put this bit in. Straight out the text, £580,000. Now the allowable cost, the extension is fine. The indexation allowance times the allowable cost is, that's not right. And the reason why that isn't right is that indexation cannot be used to extend or create a loss. So if we added these two together, we would get 750,260. They would make a loss of 200 or 100 and 180,260 or so. So we can't do that. All we can do is put that in. So indexation cannot be used to create or extend a loss, and therefore we've got no gain. No gain, no loss. So it comes up later as well in another question. So that one's restricted. Why? Last bit for now. Sell a building 31st of March, proceeds 2.5 million. The gain is going to be 763,500. So rollover relief is where the proceeds from a property, or partial proceeds from a sale, are reinvested in something similar. And there's a date, because you can't buy a property or move out of a factory one day and move into another factory the same day. It's not like houses where you're out by 12 o'clock and sometimes back in another property just after 12 o'clock. These things take years to shift plant and equipment, and you might put a property up for sale and it might take 2 or 3 years to sell it. So you have to buy your other one in advance, effectively. So let's have a look at the information in the reference material. And it's all about the gain and rollover relief. So it's this top bit here, replacement of business assets. It normally only applies to property, most often property and land. In theory it could apply to plant and machinery as well, but they will have been subject to capital allowances, so it's really unlikely you'll ever get a question on that, so I assume it's always going to be property. They've moved from one factory to another. Available to individuals and companies, examinable for companies, so you won't get asked this for a sole trader. Must be used in a trade and land and building, so if part of it wasn't a trade, let out to somebody else as an investment or something like that, or somebody lived in part of a factory or something, that wouldn't count. And then read the bits. Qualifying time period, replacement assets must be purchased between 1 year before and 3 years after the sale of the original assets. That's the information we need. And then the partial reinvestment, if only some of the sale proceeds are reinvested to buy a cheaper factory, then the gain tax will lower for and proceeds not invested. So in this case we know how much gain they made. If they didn't reinvest, well, let's look at the numbers. If they didn't reinvest £500,000, it would be £500,000 restriction. But this one's okay. The whole lot's been invested. It doesn't actually tell us it's the whole gain. That's in the bottom question. But this one will just be the date. So remember, it was a year before. So 20 March, a year before. This is 24. And the latest is 3 years after. 5, 6, 7, 8. And deferment of the whole gain, the qualifying assets, well, the whole lot's got to be invested. Just be prepared for questions on partial gain. And we'll leave this one now, and other videos for the rest of the tasks.